year, partly because, we're still in a solid expansion. Monetary tightening doesn't kill bull markets, but it creates a lot of volatility in front of it. So I think if the Fed liftoff is in the summer, by December, the markets can look a little bit past that. And so I think we're still up 10% for the year.
I mean, I'm trying to get beyond. I think 2022 is really treacherous. I mean, that's what's going to be cut, right, and spliced out of this interview. And people are going to talk headlines that, Tom Lee thinks you can get out of 21 and into 22 with a bang, but then you could have some real issues. If you think that it's going to be treacherous, and once the Fed starts to get a little more aggressive, let's say by the summer, June, as you say yourself, what kind of pullback do you think we're going to have?
Scott, as you know, in the past 12 months, we had 4 corrections of 4% or more, but every time it felt like the sky was falling. So in 2022, in the first half, I think the possibility of a drawdown closer to 10% is probable. And so I think people are going to be in widespread panic, but that would be a buying opportunity. And then in terms of positioning, I think that's why FANG is our second favorite sector in 2022.
Interesting. Joe, you have a question for Tom Lee?
I do. Tom, you mentioned FANG, and given the significant contribution that it provides, if you are going to have a 10% double-digit decline, wouldn't we ultimately have to see the weakness that we have not seen in those mega cap type stocks in the first half of the year?
Yeah.
Joe, that's a great question because, you're right. FANG the market's eventually is becoming increasingly FANG. Tech and comm services is more than 40%. FANG earnings 30% and PEs fell in 2021. So I think PE expands next year for FANG. And actually, PE derates and re-rates every other year. So our base case sort of is FANG's up 30% or more. But I think it means that if there's panic around inflation and Fed tightening, the rest of the market takes it on the chin pretty hard. So I think FANG is pretty solid in the first half, and then everything else looks really shaky.
I go, Tom, to what the Wall Street Journal is talking about today, right along these lines. In fact, you've set us up perfectly for it, as Joe has with his question to you. Gigantic stocks are a reason to worry, the Journal writes, quote, owning any company that has mushroomed in value means it is hard for it to outperform for much longer without getting uncomfortably large. Investors increasingly feel safe putting their money to work in those recent winners. Even if they are wonderful businesses, that can leave them overvalued. That is the key risk. What looks to be the most attractive, if not the most defensive, in an uneasy sea. And it's a port in that storm. At some point, even those get overvalued and overextended, don't they?
They do, Scott. I just think one of the dynamics in 2022 is if inflation anchoring is taking place in the market. So let's say investors think inflation, and I agree with Dubrovko, it's actually transitory, but I think that the contemporaneous numbers are going to be big. Investors are going to realize bonds are guaranteed to lose money. One of our themes is guaranteed TINA, that you're guaranteed to lose money on credit, every high yield bond, every investment grade bond, every 10-year. And so that would make equities your only safe haven if you thought there was inflation and the Fed tightening. And so I think FANG holds up because, the earnings and free cash yields and even the dividend yields are so big in these things, you're better off owning that than owning a 10-year bond.
Interesting. Shannon, do you have a question for Tom? And then Pete, I know you do as well, but Shannon, you first.
Thanks. Hi, Tom. Happy holidays. So when we
Happy
talk
holidays.
about, FANG as your second top sector, you've made a lot of really good calls on energy this past year. And how do you see that, especially with the potential for moderating inflation? What is the outlook for energy and materials look for next year?
Hi, Shannon. Yeah, energy is our top pick. I know it was the best performing sector in 2021 with almost a 50% gain, but we think energy stocks could produce similar gains next year, mainly because oil structural deficit, the supply versus demand gap is actually going to get bigger in 2022. So I think the market can no longer ignore that oil has price support, could get into the hundreds, at the same time that, as you know, jawboning by policymakers might tank oil for a week, but at the end of the day, it's supply and demand that's helping set the price. So I think energy stocks, which are under-owned and they're better managed, they're producing a lot of cash flow, and now they're cheap relative to oil. I mean, that's three strong reasons for them to really shine next year and I think outperform FANG.
Yeah, it's an interesting call to be able to back up the kind of year that they have had. We'll see. Pete?
So, Tom, here's my question for you. I know everybody used the expression FANG, but are we talking more than FANG? Are we talking about mega cap tech? And if so, are we also including the subsector of the semiconductors that have had an unbelievable run of late? Are those included in what you're talking about in terms of second half and some of the performance that we would see?
Yeah, absolutely, Pete. Yeah, FANG, I think, is better word to describe like a type of company, which is a company that has a very high Herfindahl index, you know, large market share, has proven that they don't have to worry about pricing. Their end markets are growing. It describes FANG. It's now describing a lot of semis, as you said. It includes companies like NVIDIA. So I think FANG is a characteristic of some of the best American companies. I mean, at the end of the day, we have to remember, U.S. FANG and U.S. tech leaders, I mean, they're pretty scarce in the world. You can go into any other country, you don't find companies like this. So I do think an alternative, Tina, is that the U.S. stock market's really the safest place to be.
Hey, Tom, let me ask you this. I mean, we've basically, let's just say, since 2009, we've had the easiest money policy from the Fed of any of our lifetimes. I think we can make that statement, or certainly close to it. Can we say that the best days of equity returns for investors are behind us at this point? If you think that it's going to be tumultuous next year because the Fed's going to be changing its policy, and we may only get a 10% rise in the S&P, and then if you figure the Fed is only going to get tighter from there, right? They're going to have to try and fully normalize policy at some point, theoretically. Doesn't that make it much harder for years to come by the returns that we've grown so accustomed to over the last decade at least?
Scott, I'll agree, because I might just make an observation that since 2009, we all know that more than half the return has come from multiple expansion, or the PE expanding, whereas S&P earnings growth has actually been held back because of lack of inflation. Nominal inflation picking up actually has a 3 or 4 beta to earnings growth. So the next 10 years, to me, we get less boost from PE expansion. But I think the millennial tailwind, and we've written about it extensively, because the number of people age 30 to 50 in America is actually starting to really accelerate, similar to the 80s and into the 90s. I mean, that to me spells that earnings growth probably is structurally stronger. I think it's a possibility that we could compound S&P at 20% in the next 10 years. So it could actually be better than 2009, but it won't be PE. It actually has to be coming from earnings.
Tom, I'm going to let you run. Again, I know you're on holiday, and I do appreciate your time making some for us. I wish you a happy, healthy New Year and many visits with us in 22.
Yeah, thanks to you guys. Wish you the same, and also to all the viewers.
All right, thanks. That's Tom Lee.
Yeah, I agree with Tom. I think what we're positioning, as he laid out, is that the Omicron is not as bad as we thought. It's not like it's going to be a pathogenic impact. So it's going to continue to push markets. We're still seeing the growth of the earnings multiple, as he pointed out, and we're seeing that quality tech is still the place you want to be. So I agree with Tom on this one, and we're actually positioning our portfolio in line with what he indicated. Also, the growth or the opportunity in healthcare is another growth area that's going to do very well into 2022.
Shannon, the money line, as I focused on with Tom after he said it, is I think 2022 is really treacherous. Is that how you feel? That, once the Fed starts to get in the game, that it's going to be a much more difficult environment to make money? Now, there are many people, and by the way, I'm looking at my Twitter feed as we're having this conversation, and the notion that Tom Lee says you can only get 10% out of the S&P is, there's a connotation that's a negative year. It's relative to what we're having this year, certainly negative, but how does that sound to you?
So I would argue that when you think about the word treacherous, and I think, the way that I took that statement was thinking about, where you want to be positioned, and perhaps that you may need to be positioned differently in the first half of the year versus the second half of the year, which I very much agree with. But we've talked about this on the show the last couple of weeks in particular, Scott. It's been a little treacherous under the surface this year, too. I mean, there's a lot of stocks that haven't performed, and yet the benchmark has done really well. So I think, again, looking at it from the perspective of, can you continue to maintain the same positioning in 2022 that you did in 2021 and yield the same results? Likely no. And that inflection point, I think, is where we're going to hit that treacherous point when folks aren't exactly sure when to make that switch. And to Joe's point earlier, that's why you don't want to be too far out on the ends of the spectrum. I loop energy and materials into that as well. But I think that's how I view that term treacherous.
Yeah, and I know everybody's thinking about what 2022, Joe, is going to hold for tech, because the concentration in mega cap tech, as we discussed, some of the other names that have gotten really obliterated, the high multiple stocks, or no multiple, as Pete likes to refer to them. I want you to listen to Gene Munster, the one-time tech analyst, now venture capitalist. Sorry? Oh, well, okay. We don't have the sound, I'm told, but let me just paraphrase to you, or at least quote you, if I can, the best that I can, on what he said, Pete. Investors in big tech should enter 2022 with a healthy dose of caution. I'm more in the camp to brace yourself in big tech for at least the first 3 months of the year. So that's Gene Munster, Loop founder, managing partner. What do you think of that?
Well, I think what Gene's probably alluding to there is sort of what Tom's talking about, which is we're going to probably see some volatility and some pressure on the markets after this unbelievable run in 21. So to start off 22, tumultuous, that actually is probably a pretty accurate description. And as we've seen in the past, Scott, when eventually, as they're starting to sell and the selling accelerates, we did start to see some of those big cap names start to move a little bit to the downside, right? We saw Microsoft pull all the way back, much lower than it is right now, as a matter of fact, and Apple and all those names, Facebook, you can go through the list. All of them did pull back to some degree. So I think that you still have to be very selective and when you want to start acquiring some of these names. And if you believe in what Tom's talking about, and I do, and you see some pressure on the markets like Gene's probably alluding to, I think that's why you're looking for the opportunity in the first 3 months, maybe even the first 6 months of the year, when you see some of these stocks getting sold off to the downside. They're obviously on your list. We talk about having shopping lists all the time. You're looking for those names that you really like, that you think are the quality names that can survive and grow in a very difficult market. And I think that there's going to create some opportunities along the way.
Joe, let's say you have to be more selective, and let's take mega cap tech as the area specifically that we're talking to, and you have to be more selective. You can't just say, well, I like the FANGs. And I point out to you that Alphabet was the top performing big tech stock of the year, up 68%. Now, Microsoft at 50% obviously had a great year. Anybody would take Apple's 33% on the year or Facebook's 23%. All those are fine. But if I had to be super selective, where would I go? Would I stay with an Alphabet, which you own, along with Apple and Microsoft and NVIDIA as well? But how do you answer that question?
I answer that question by looking for an edge. And when I say looking for an edge, it's understanding that in 2021, we had the best risk-adjusted return for the S&P since 1990. We're not going to have that moving forward in 2022. We're going to have more volatility. Tom has told you that. Specifically for the FANGs, what's my edge? My edge is the capital allocation strategy. If you look at Alphabet, the reason that Alphabet has had such a dramatic catch-up in terms of its performance relative to Apple, relative to Amazon, relative to Microsoft, is it has embraced the Apple model of a share buyback that is beyond street expectations. Over $50 billion so far in 2021. So your edge is these mega cap companies that are committing to return capital to shareholders. And Scott, I wonder, maybe in the case of Amazon, that's why it's underperformed in 2021 relative, because it does not have the strength and the edge that it provides the investor with that capital allocation strategy. So that's what I'm looking towards in 2022, and it's not going to change my positioning. I'm going to be there with Microsoft. I'm going to be there with Alphabet. I'm going to be there with Apple, because they're going to do me right in terms of buying back their stock.
All right, we're going to have more stock picks for you coming up, because straight ahead, our stock summit returns. You remember at the middle of the year, June or July, we asked everybody to give us a few picks for the second half of the year. Well, now is the time that we break out the scorecards. We're going to go through the hits and the misses. We're back in 2 minutes.